Hello and welcome to Hedge Fund Tips with Tom Hayes for the week ending June 19th, 2020. Exciting week. We've got a lot to cover. This is VideoCast number 35, podcast 25. So as we usually start out, we're going to cover a little bit of the media spots this week and then go right down to the nuts and bolts of this week. First of all, I'd like to thank Melody Hom and Susan Smith for having me on Yahoo Finance on Wednesday. And we're going to go through a number of the points that I covered. We talked a lot about institutional positioning and outlook and sentiment and its potential implications moving forward for the market. We talked about banks and cyclicals, so we'll cover a lot of that. If you haven't had a chance to view it yourself, you can just click there and watch it right at hedgefundtips.com. So thanks again to Melody and Susan Smith. Next was on Monday, Devik Jain and Mehta Singh had me in their article on Reuters. And if you remember, I believe the futures were down, and he was saying, well, why is the market down? My quote was, people are fearful about new cases rising, but at some point when you move 45% off the lows in such a short period of time, any excuse will do to have a nice consolidation of the gains, said Thomas Hayes. So interestingly enough, how we started out is how we ended up this week. Fear of cases rising and an excuse to continue the consolidation range, which is thematic of what we're going to be talking about in this week's article as well, the kind of 2 steps forward, 1 step back consolidation for the last 3 days now. So thank you to Mehta Singh and Devik Jain for including me in your article on Monday. And lastly, this was an interesting one in Bloomberg this week. Laura Hurst from Bloomberg, thanks for including me in your article. And all these you can just view on hedgefundtips.com, click on Featured On, and then there's a link to take you right to Bloomberg or right to Reuters or right to Yahoo Finance so you can see the full text. But this one was about BP, and this is actually a really good sign. BP took a $17.5 billion write-down earlier in the week based on they took their expectations for prices of oil down materially, and then just took the book value down of some of their assets. Paper loss. What it affects is debt to equity ratios, but you're going to see in a minute how that played out. But my quote was, because everyone was saying, oh, that's the end of BP, they took a $17.5 billion write down. And my quote was, the BP announcement kitchen sinks it so that long-term investors can step in with much of the worst in the rear view mirror, says Thomas Hayes. So the point was that they were just basically cleaning house. Pessimism is so low, sentiment so low, it's priced in the stock. Now's the time to take it because you don't want prices to start to rise and earnings start to rise and then you're just pounding yourself taking these minor long-term impairments. Just take them all at once. That's exactly what they did. And sure enough, 2 days later, they raised $12.5 billion in the credit market, some type of hybrid I think it was a convertible or debt equity combo. But they kitchen sinked it early in the week. That opened up the floodgates for them to raise the capital they need, and now they can just move ahead. And as we're seeing, there were a bunch of articles out today. The rebalancing is happening much sooner than expected, and we have some data that we're going to point to that we also referenced in our article on Wednesday that we've been talking about for weeks and weeks, where we said, look, this OPEC cut is a bigger deal than people are anticipating, because it wasn't just 2 months. People were thinking it was just May and June. It was May and June, 9.7 million barrels, but they increased that again to 10.7 in recent weeks. But more importantly than the 9 or 10 for 2 months was it was the first time that you have a 1.5 year runway. Starting in July, it was to be 7.6. Now it looks like it might be more than that. 7.6 million barrels till the end of the year. Then in January 2021, all the way through April 2022, another 16 months, was going to be 5.6 million barrels. So that rebalancing is starting to get priced in, and we saw Brent in the low 40s this week. And I think that trend is going to persist. So I think BP set themselves up really well by kitchen sinking it. It's interesting. It kind of reminds me of what's happening with financials. Everyone is so fearful of them cutting the dividends. I wish they would just cut the dividends so the stocks could rally. I'm not sure that they're going to have to. Randy Quarles put out a speech about the stress tests that I tweeted out today. My handle on Twitter is @HedgeFundTips. You can check out the speech there. But my takeaway from reading the speech transcript was that he was basically saying that the banks have already done a lot to conserve capital through the COVID by stopping buybacks in Q2. So my sense is that they're going to say, as long as you keep a short-term handle on the buybacks, we're not going to force you to raise more capital or stop dividends. I could be wrong. We're going to get the results on the 25th. But I think regardless of what the outcome is, if they cut dividends, if they don't cut dividends, we just need an answer. That's what the market needs. Okay, so it's just as positive if they don't cut dividends as if they do cut dividends. We just need some finality so that because they're trading at a discount to book. 95% of financials are trading at a yield greater than the 10-year yield. They're sitting on $500 billion of cash. So they're well capitalized, and so far nothing close to what would be the worst case expectation out of COVID that people could imagine in March has come to bear. Certainly that does not minimize all the jobs and all the deaths. It's been a tragedy beyond belief. But in March, it looked like it could be a Great Depression, and had the policy not kicked in formulation and implementation with mass brute force, we would have had a depression. But policymakers learned from the past, and they got ahead of the curve, and that's why we're seeing positive outcomes, and that's going to continue. So I think this BP story is a good model for what could happen to banks next week after the 25th. And we used today, and we used weakness at different points this week to really get material exposure and to add to exposure in that sector. And we just want to see the finality next week, whether it's good news, bad news. It really doesn't matter. It's pricing in bad news right now. So anything that's less than either the news gets announced so you can sell the rumor and buy the news, which is what they've been doing, or you get better than expected news, then it could just really be a rocket ship off of that. But looking at the way the yield curve steepened, which we've covered in recent weeks, the table is set. Financials over the next 3 years, I think is going to be a fantastic relative strength trade. So thank you again to Laura Hurst for including me in that article on BP. Now to our key article of the week, which is the Drake Tuesday slide stock market and sentiment results. This week was my daughter's 6th and 8th birthdays, so they're at the age where they like dance music. So I'm learning about all this stuff, including the Drake Tuesday slide. And what was great about the Drake Tuesday slide is it was a perfect song to capture the theme of this week's sentiment and for the last 51 days, because as much as it feels like we've gone straight up, it hasn't quite been the case, and we're going to go into that. But the lyrics that represent the last now 53 days is it go right foot up, left foot slide, left foot up, right foot slide. Basically, I'm saying either way, we about to slide, can't let this one slide. If you click on the video on YouTube here, you'll see effectively he's doing this dance, but he's going nowhere. And that's what the market's been doing. So, and it has a nice beat to it, so check it out. But if you look at the chart below, you're going to see that subsequent to rallying 35.5% in 36 days off the March low, that was the rocket ship higher that a lot of people missed. That was the huge move. But basically for the last now 53 days, we've effectively consolidated sideways above this mean range here. And as of when I wrote this on Wednesday night, we were up about 5% in now almost 2 months after going up 35% in a little more than a month. So this is effectively the 2Z slide, and we're consolidating and digesting these gains, getting new data. And the data is critically important because, as I covered with Melody Ham on Yahoo Finance on Wednesday, by and large, the vast majority of the data has dramatically exceeded expectations over the last couple of months, which is why we continue to rally and why the market continues to discount a constructive future. So this is the economic surprise index. The Citibank Economic Surprise Index. This is at record highs. This is just a phenomenal number. We're going to go through some of the economic data, but one of the other things you can look at here, not only do you have the Citibank Economic Surprise Index, this is the U.S. leading economic indicators, which we're going to cover coming up. But effectively, if you look at each time that the leading economic indicators have gone from such a negative number, such a material trough where this is red, to such a high green instantaneously at that inflection point. So we're looking at just now that's happened. Okay, so we went from record negative 7 and change, looks like 7.5, to plus 2.8. That was this week, that print. The last time that happened, you went from almost -4, negative 3.75 to positive 1.75. That was in 2009. That happens at the beginning of a bull market. That also happened down here in 2002. Went from basically -2 to positive 1. Deep red to green, that started the beginning of a bull market. So effectively recession to expansion. That doesn't happen at the top. That happens after you've had the crash. We had a 35% crash in March, albeit it was quick, but that's what we had. Then it happened in 95. For those of you who were around, you remember everyone was worried that was when things were going to roll over. The Fed did 3 quick cuts and extended the cycle. You went from -2 to positive 1, and you got another 5 years. Then you had the recession. For anyone in real estate remembers, the early 90s was a real estate recession, but it also hit the market. You went from -2 to plus 1, and that was a very short-lived recession in 90-91. And then the last time you had this was in the early 80s, which set up the 18-year bull market. You also had it in 74 coming out of that crash, etc. So this is a very good sign when the leading economic indicators go from very red to very green. It sets up multi-year rallies historically. So that's just something to bear in mind as we look at the economic data continuing to beat, as we covered with Melody Ham. The next thing that we talked about was the outlook of managers. So each month, Bank of America does a global fund manager survey with about 200 managers managing $500 billion. What's interesting is after, trough to peak, it was like 45%. It's come back a little bit. Despite that huge move, 53% of these institutional managers still say the comeback from the March lows was a bear market rally. The last time that you had that level of pessimism, where you had a monster rally, was from March of 2009 to August of 2009. The market, S&P, rallied 52% off the lows, and everyone was calling for the same thing. And the reason that they were calling for the same thing is because the economic data was getting better, but not hugely better. So people thought that they were going to roll back over and take out the 666 lows on the S&P. Meanwhile, anyone who'd bought even after the market was up 50% did exceptionally well over the next 10 plus years. And I think we're in a very similar situation right now, albeit we have to consolidate such a huge gain in such a short period of time. This is the beginning of a new cycle. that we're seeing, and we're seeing it in the economic data beats, and we're seeing it in this level of pessimism. The market has to climb a wall of worry. If everyone believed that we were through the worst, we would be at a short-term top for sure. Only 37% believe this is a new bull market, so again, that's in line. Only 18% of investors expect a V-shaped economic recovery. Net 46% of participants in the survey expected a prolonged recession. Now, this number halved. Last month, 93% expected a prolonged recession in April. So the pessimism is thawing on some fronts. That's good to see. That's, again, climbing the wall of worry. And 78% believe the market's overpriced. That's the highest since 1998. And if you remember, from 98 to 2000, it was about a year and a half to 2 years, you had about a 56% rally in the S&P. So that is the kind of outlook and the pervasive pessimism that allows us to continue to go higher over time. That's not to say we won't have our mini pullbacks in the interim and be a little choppy, but the multi-year outlook is up. And this is also referenced in the position. Look at the positioning here. The top four are defensives. U.S. cash is number 2, healthcare, bonds. Those are the top 3. Now, they did take down tech, where we've been talking about the froth for the last couple of months. They did take that down on a relative basis, and they started to leg into cyclicals, albeit not in a material way, but you're seeing some action in commodities, so people are starting to buy into that story a little bit. And also, managers started to buy less popular groups such as small caps, value, and Eurozone and emerging markets. As a matter of fact, I could be wrong, I think emerging markets closed positive today, even with all the volatility. These are the type of things that you see. I know there's this great debate about value versus growth and tech versus cyclicals, but it's not about that. It's about timing in the cycle and coming out of a recession. And it doesn't mean that tech won't continue to go up. It's what we're looking for is relative strength as far as how we weight things and what we focus on, what performs best at what time in the cycle. Not all or nothing, but relative choices. So it's nice to see that this slowly starting to happen, despite them still being so defensive after a big move, which is good because that gives further fuel. The higher it creeps up, the more they have to chase in. Now, the other thing parallel, I just talked about that move from March 2009 to August 2009. The other parallel is that investors took cash levels down from 5.7% last month to 4.7%, and that was the biggest dash away from cash, as Bank of America called it, since August of 2009. So the last time this happened was after a 50% rally in a handful from March through August. Now, after a 45% rally from March through June, in this instance, we're having the same thing. And again, that was closer to the beginning of a multi-year rally than the end. The rotation is also positive, and the decrease in technology and moving into those materials and energy, and slowly but surely, not a big jump yet, but the beginning of that trend change that you see at the beginning of cycles. Very positive news. Couple other things I just want to cover from the summary, and you can see this Bank of America Global Fund Manager survey summary also on the site under popular post. You just scroll down here, you see it was the second popular post this week under the Drake article that we're covering now. The other thing that's very interesting is you're seeing a lot of people come out saying that the returns for the next 10 years are going to be subdued, 0 to 5%. It was, I think, 67% of managers. 67% say the next decade will have an annualized global equity return of 0 to 5%. I'll take the other side of that because, number one, they said the same thing coming out of the 2009 cycle. After the crash, everyone's pessimistic in the short term. Number two, we put on some emerging market exposure. And the one thing that I thought very interesting when looking at the long-term emerging markets stock chart is that you can buy, first off, you can buy ex-US equities at 8-year-ago prices today, even after the rally off the bottom. So you can get Europe, developed world ex-US exposure for 8-year-ago prices, number one. Number two, you can get emerging market prices for emerging market exposure for 13-year-ago prices. So what they're effectively saying is, rear view looking, what's happened in the last decade is going to happen in the next decade, and history often refutes that. The higher likelihood is a reversion to the long-term trend line, which it's underperformed. As a matter of fact, I think I did something in one of these notes, maybe somewhere in January. We took from the March 2000 peak to the highest peak. I think it was in whatever we peaked, February of this year. You can either measure trough to trough or you can measure peak to peak. But it was something like, including dividends for the S&P 500, it was like 2.5% to 3% compound annual growth rate for the last 20 years. That pales in comparison to the last 100 years, which is over 8%. So in some sense, we've actually been under trend for the last 20 years. And where people get misled is they measure from the trough in 2009 to the recent peak and say, we can't sustain these type of things. But if you look, we basically had a sideways market for 13 years. We only broke out in 2013. So when you revert back to the mean trend over the long term, we're well underneath. And as we revert back to have another 10 years, certainly on a global basis, but even on a US basis, if we revert back to anything, it wouldn't be 0 to 5. It would be closer to the 8 to 10 that we've historically been accustomed to, dealing with the biggest, most productive, biggest moat companies in the United States that are represented by the S&P 500 and have global exposure. So I wouldn't buy into the new normal pessimistic 0 to 5% story on a global basis, because that's what we did in the last 2 decades, not necessarily what we're going to do in the next 2 decades. I'd be more in line to take a look at 82 to 2000. I'd be more inclined to look at 1948, when we were 120% debt to GDP, similar to where we're going to probably be by the end of the COVID crisis. And 1948 to 1968 was a huge secular rally in equities. We took the debt to GDP from 1948 to 1953 from like 120 down to 63. Same thing's going to happen. We'll grow our way out of it. Everyone's saying where we're going to get the money. We're going to get the money from growth. Fed put out numbers. They're looking for 5% GDP growth next year after we come out of this. I think it could be more. We got 12% of global GDP and fiscal stimulus. So there's a lot of positive things going on. And when you're kind of in the middle of the storm, it's hard to see that. Borrow my glasses here. Look at history. No one knows for sure, but if you kind of look how things perform after long periods of consolidation, there is a tendency back to the trend line, and there's a lot of things in place that support that, among which in the United States we've got 85 million millennials now doing housing. The most popular age for millennial is 29 years old. They're starting families. They're now moving out to the suburbs. This is a very, very positive thing. Same thing you had in 82, same thing you had in 52. So lots of good things happening on that front. As far as managers, this is the V shape and U shape. There's still a lot of pessimism there. And the positioning we covered. The most crowded trade is still U.S. tech and growth, and the biggest tail risk, and that's why you saw a little weakness this week. How we started out is how we ended up, is the second wave of coronavirus, with 49% of those surveyed citing as a top concern. So their fears, in some sense, were realized this week as you saw spike ups in Florida, California, and Arizona. However, if you look at cases You can't see the end of this, unfortunately, but it's still trending down. Yes, there were spike ups here. The healthcare system is now in a position to handle it, but obviously, it will be important for people to get the message, continue to practice social distancing. I think there's no downside to wearing a mask when you're in public places. Certainly indoor public places, I just think it's smart business, because if in many regards, if you're patriotic, you want to see the economy flourish. So why wouldn't you wear a mask inside so we can just get the economy just cranking and hit that 5 or 6% GDP coming out of this? That's patriotic, So leave, if it's become a political football or whatever it is. I mean, there's no downside to wearing a mask when you're around a lot of people, and there might be material upside. Certainly wearing a mask won't slow GDP, and it might dramatically increase it. So I just say, until we see cases across the board coming down, certainly deaths are coming down. That's the good news. The healthcare system is much better prepared, and they know how to treat it much better than they did 2 months ago. So as that death rate comes down and down and down, that will be very positive. That's going to give people confidence. We expected these little flare-ups in different areas. That's happened. That's going to continue to happen. The healthcare system can handle it. But if we all do our little part, try to practice social distancing, do it. It's a free country. You can do whatever you want to do. But if you want the economy to grow, I think in crowded indoor places, it's a good thing to wear a mask for the time being until we get past this, and that's going to just crank up GDP. So that is that, and that's the tail risk. So the other aspect, besides the embedded pessimism among institutional managers, even after such a huge move, is you're seeing, this was a new statistic, a material amount of people actually sold all of their equity holdings in March and April, and that's really sad. They probably got scared off by a lot of the media was very, very negative during that period. And if you look at by age group, 25 to 30% of people from 60 to 70 plus sold 100% of their equity holdings at the lows in March. The March period, and about 18% of everyone. So 1 in 5 people sold all their equities at the lows. This is sad, and that cash now on the sidelines is going to get forced in. The more it gets pushed up, the more they're going to get forced in. It's going to be very similar to August of 2009, after the market had rallied 50%. People just had to start to participate, and that's okay, because in some sense they missed a lot, but in the other sense, in the scheme of a multi-year cycle, there's a lot of room to go. But this is all fuel, because they'll just have to chase to meet their needs in the future and participate in this. And it's just sad to see these numbers, but that's dry powder. The other thing you're seeing in terms of dry powder is money market funds. AUM has shot up since March to a new record. So looking at this chart here on Barron's, the last time it was even close to this was right after the lows. Again, a month and a half after the March lows, April 30th of 2009. That was the beginning of the last cycle. And here we are a couple months after the lows, the beginning of the next cycle, and it's even, the cash levels are even higher than they were in April 2009. And the time before that was, guess what? February of 2003, the beginning of that cycle. So, all signs are pointing to this dry powder will have to get back to work, and that leads to multi-year bull runs. You have the institutional money, you have the retail money, the money market funds, and all the people that sold out at the lows. That's all going to be fuel. The higher we go, the more of it's going to be forced in. The other thing that we covered here quickly this week was the CBOE skew index. You can read this. I put the definition. But basically, the primary difference between VIX, which everyone knows, and the skew is that the VIX is based on implied volatility. It's basically the pricing around at the money strike price options, while skew considers the implied volatility on out of the money strikes. And when this number goes really high, it means really high, meaning it ranges between 100 and 150. So really high is above 150. It means that people are taking out, there's demand to take out insurance on tail risk, like some crazy thing happening. Now, the thing that's interesting about this 150 number is it precedes pretty much every single major crash. However, every time it hit 150 doesn't mean a crash happened afterwards. So in other words, if you look back and you look at every crash, you can say, oh yeah, I see a few months before the skew had hit 150. But if you look at every 150, there wasn't a crash. So take a look here. In the last instance, in early 2020, the skew did hit 150, and we did have that crash in March. Same thing in September, October of 2018, we had the December crash. However, in October of 17, we rallied materially after that for another 90 days. Same thing in July of 2016. Here, you were coming out of it. So again, the point that I was making is we haven't even hit 150. So if we'd hit 150, I could say, listen, and look at all these instances. In the high 140s, we're actually mid-rally from 2013 to 2015. The market just kept going and going. They kept hitting. People kept betting on the end of world above 140, and the market just kept going. Here, we just hit a peak of 137. It's more in line with what you see mid-rally. Obviously, you had these tiny little pullbacks, 3 to 9% consolidations during the rally from 2012 to 2015, just like we had the 6% pullback last week. But there wasn't enough acute betting on tail risk and demand for that tail risk that would precede a crash. And even if we had that, then we'd have to take a look at, okay, a lot of people are betting on tail risk. Does it mean we're going to have a crash, or does it mean that people are just worried and we're going to climb the wall of worry? So the point of putting this data point and this indicator in this week's report was to say that we're not even at the point where we have to decide what is that signaling. Is that signaling that there's just too much fear and we can climb higher? Or is that signaling that we're due for a real crash like we had in December 2018 and March 2020? And the last time would have been January of 2016. You had the 150, and then you had the 20%, almost 20% pullback. So we're not even at that decision point, and that was the point that I wanted to make clear, because there's so much talk about rolling back over in a material way, and the numbers on this particular indicator don't support it. Now, we have an Ask Me Anything question this week that is going to talk about why we don't just rely on one indicator, but this one is an important one that I haven't touched on in previous weeks that I thought would be helpful. Now, I also did this as one of the indicator of the days this week, and I used an actual reading on the opposite side. I was using reads below 115 as contra buy indicators, and those reads work actually much more precise. So when you get above 150, you say, okay, people are worried. Is it justified, and are we actually going to get a crash? And it's, 50-50 or 60-40. But when you get below 115 after the market's corrected, that's usually a pretty predictable buy point, and that's what we cover in the indicator of the day video. You can have a look at that to take a look from the other side of the trade, and that's a pretty good indicator to keep in your arsenal. Now, continued signs of recovery this week. Credit spreads are coming down. You can see every time credit spreads come down, it's the beginning of a cycle, not the end. After the January 16 crash, spreads came down. After the December 18 crash, spreads came down, market rallied. Same thing after the Euro crisis, late 2011, spreads came down, market rallied. Same thing early 2009, spreads came down, market rallied. Multi-year rallies. We're seeing the same thing now. Spreads came down, markets are going to rally, have rallied, and are going to continue to. Again, that never precludes the normal consolidation pullbacks, 3 to 9% like we saw last week. We'll probably have a few more of those at some point this year. But, the trend is the foundation has been laid for, on balance, constructive things to happen for several plus years to come, and I think many, many more than that. The other aspect, obviously, we saw retail sales. What a huge difference from they were expecting. I think they were expecting +8. We got +17.7%, off the charts, led by clothing of all things. You can take a look. Clothing, furniture, and furnishings. So clothing was up 188%, furniture and furnishings up almost 90%, electronics and appliance 50%, motor vehicle parts 44%, food and drinking up 30%, gas stations, people are starting to get out there, garden and building, and grocery was only up 1.3, which is good. That means people are finally stopping to cook at home and they're going out, so that's a good thing for restaurants. Okay, also, flatbed trucks went through the roof. The F-150s, that's a leading indicator of construction. That's a good thing. Next was shipping prices rebounded to pre-pandemic levels. A lot of runway there. And the death rates. This is more important than hospitalizations and new cases. Those continue to plummet. New York, New Jersey, Connecticut, we got hit the worst, and we have managed it the best. And, look, I go to the supermarket, people are wearing masks. I know that's not the case in everywhere in the country, and understandably so, because when it's not so acute in your area, you don't really recognize the risk, and the risk might be lower. It's certainly the case, but why not keep it that way, right? So indoor, I think it's a good thing. I mean, they're not comfortable. We had the birthday parties with the girls. We went to this awesome restaurant called Bernard's. French place, and we were outdoors, but the girls still wore masks there, and then when you're eating you take them off, and it was fun, and it was no big deal. What's easy to do is easy not to do, right? The difference between success and failure. It's easy to do, it's easy to wear a mask, and it's easy not to wear a mask. Why not wear it until things get better, and let's just grow the GDP like crazy and get everyone back to work. Okay, next. We've talked about this at length in recent weeks about my expectations with regard to the impact of the cuts would be over time. Rystad Energy put out a great chart here, kind of laying out what, we had this huge build from January of 2020 all the way through May of 2020. And this is the month that it inflects, June. Okay, so we took some additional energy exposure in a select name this week. And if you just look now for the next year and a half, that runway with the long-term cuts and the increasing demand is going to lead to monthly deficits of 2 to 4 million barrels a day moving forward. This is a huge secular opportunity, like we're the beginning of a cycle, but I think secular meaning many years, but it's the beginning of this cycle. Like we saw, if you're wondering what could be a model for this type of behavior, I would take a close look at 2003 to 2007, what happened to energy demand, and also as we see emerging markets coming back online. The other thing that there have been a lot of people out talking about is a weakening dollar. That would be great for emerging markets. It would be great for this story as well. And that's also consistent with, I think 3 months ago in the survey, we talked about managers being having a sentiment not seen since the last time the dollar weakened by 30 some odd percent. I have to go back and look at that, but it's finally starting to manifest, and that would be a very, very good thing for this thesis as well. It's constructive with the whole cyclicals theme we've been talking about for the last 8 to 10, now it's 12, almost 12 weeks now, since mid-March. So, finally, the short-term general view for the market. This was the biggest surprise of the week in my view. The AAII sentiment survey result, after a 45% plus rally, was only 24.37% bullish. It plummeted from 34% last week, and that is historically a contra buy indicator. Anything in the low 20s, obviously 20 would be like the miracle number, but anything in the low 20s has been a buy. and the bearishness shot up from 38 to 47%. A lot of bearishness came into the market, and that is, I actually went through the chart every time that the bullishness slipped below 25, and you can see, these have been unbelievable buy opportunities when the sentiment gets that low. This one was a hair early, but what a move afterwards. Again, great. Here you got to bounce and roller, so that one failed. But statistically speaking, and that's all you could ever do is have a statistical advantage. Nothing's ever guaranteed. But I was really excited to see the pessimism get that high. I saw it in the Bank of America Global Fund Manager Survey. I saw it in the cash levels. This confirmed it. And then, the Fear and Greed Index was at a neutral position, 51. We went from, if you remember, if you can look back at the notes, you can look back by just clicking on this right-hand side under categories on the website. You click on sentiment or commentary. You can see every note every week. Look it up next to the chart, and you can see how we tracked. We were at 0 in March, and we were like, this is, pound the table buy. We never got to this extreme where you want to start to lighten up, over 80 to 100. We never got to that euphoric level, and you can see it charted out here. So to see this even come back gives us more room. You hate to see things at like 70 when you're adding new positions to laggard sectors. It's nice to have that runway where the sentiment can continue to grow with your position. So we definitely got that in spades. The National Association of Active Investment Managers, they puked out after the 6% pullback last week. Someone asked me, I just want to pull that up this week, because that number actually only changes once a week. And someone was asking me where it's at now. So let's see if we got an update. Okay, so it's back up to 88. So they puked out last week. Then the market started to come back. They're back overexposed. So that one's a little bit mixed, and that's why we never use any one indicator. So it's back up to 88 right here, and that can stay elevated as the market rallies. That look here in 17, that type of behavior happened, got all the way up to 100. So there is room there as well. My guess is that they laid off some risk today just based on the intraday pullback, and then the Nasdaq closed positive. So the message was basically the same. I said here last week, I said we'll likely get some mini pullbacks. That was, I write the articles on Wednesday night. The next day we got the 6% pullback. It was quicker and deeper than I expected, but these are opportunities. If you're looking at all the things that happen at the beginning of a cycle, anytime you get weakness is a gift. And that's when you can add, we're adding to cyclicals on all weakness. We had an opportunity today. In banks we added, a little bit in energy. And we're just going to keep building those positions because those are the type of stocks that do exceptionally well coming out of the cycles. And then mid and later cycles is when tech dramatically outperforms, as we saw in the last couple of years towards the end of the last cycle. So we like defense stocks, we like home builders, energy, small caps, and banks. Now, if you did not listen to this last week, I would suggest you click on this Carly Pierce, I hope you're happy now, to get familiar with the bank thesis, and I talked about it on Melody's show. The last two times that you had the 210 yield curve steepen this quickly were 2009 and 2003. That gives banks net interest margin, incentivizes them to extend credit, and that profitability drops to the bottom line. We have the exact same setup that we had in 2009 and 2003 when banks rallied dramatically for the next in the last cycle 8 years, and in the previous cycle 4 or 5 years. So we're at the beginning of that. Banks are cheap, trading at a discount to book, huge cash on the balance sheet, and the yield curve just steepened. Not to mention the $20 billion of fee income from PPP that's going to show up in Q2 earnings that no one's talking about. That's going to offset a lot of credit reserves that banks are taking. That's already known and a good thing. So be nice if we got one last sell-off in banks, maybe either before the stress test results or as a result of the stress test results. Maybe people, view it as bad, whatever, and that'll probably be it. I mean, they're just not going to, knock on wood, but they're just not going to get a whole lot cheaper from here. So if you get a sell-off this week in the banks, that's probably your last chance in for many years to get them at these prices. Discount to book just at the beginning of the cycle. All right, next thing we have let's make sure we covered everything from this. So we remain very constructive in the intermediate term. We'll take advantage of any additional buying opportunities in laggard cyclical names should they arise over the summer. And while we've been doing the Tuesday slide, the Drake song, sideways for the past 51 days, we're now due to move out of the range. And I think that's going to be happening in coming weeks and months for sure. So that was the article of the week. We went through cash levels. What caused the weakness today? Actually, Devick called me from Reuters today. I don't know if that'll get in his article, but basically Apple announced that they were going to close stores. The headline was they were closing their retail stores in Arizona, Florida, North Carolina, and South Carolina. Market sold off 300 points. It recovered almost 100% of that, and then it just weakened a little bit into the weekend. That's normal. People don't want to go into the weekend with risk. But it wasn't what the Bloomberg headline said. If you actually clicked and read on the article, it's 11 stores in 4 states. So you're basically looking at, little less than 3 stores per state, not all the stores in 4 states. So although it's not good news, it's not the end of the world. And likely it's someone who works in their store tested positive, so they're probably going to close it down, do the $40,000 cleaning, and then open it back up. So it's probably less bad than, but the market, because managers have that lurking fear, which is going to continue to climb the wall of worry, second wave of coronavirus, you can see it right here in the table. When they get headlines like that, the algos sell off and managers get nervous. So that's a good thing. That's how you continue to climb higher. You can't do the whole climb in 1 week. So we'll have these mini flare-ups. We expect these flare-ups, and we can each do our part individually. You're enclosed inside places. No downside to adding a mask. So that was that. Next point I wanted to go through was the economic data from this week. And I wanted to get into granularity. Why are we crushing it? Why are we beating it on every single front? So first off, the Baker Hughes rig count this week. Rigs dropped another 10 rigs to 189, low prices cure low prices, down from 1,600 rigs in December of 2014 at the peak. So if you don't think energy prices are going up in the next couple of years, and you don't think there's going to be any inflation whatsoever after Clarita got on and said today on Liz Clayman's show, we're not even thinking about lowering our inflation target of over 2%. They're going to keep the pedal to the metal with stimulus and whatever is required to get everyone back to work. The other thing that he said, which was really good for the banks, is that she asked about negative rate policy, and he said 17 members in the last minutes said that negative interest rate policy was not a good idea. That view has not changed. So they know not to do negative interest rate policy because they see what a zombie economy looks like in Japan, which did negative rates, and in Europe, which did negative rates. If you want to destroy banks and you want to destroy the extension of credit, which is critical to a recovery and to an expansion, the surest way to destroy an economy and to destroy banks is to do negative rate policy. These are smart people who have studied history, which is why they got ahead of the curve this time versus in 2008 when they were behind the curve. They got ahead of the curve with policy. They know what negative rates is. They're not going to do that. They'll purchase as many assets as possible. They'll do yield curve control. They have forward guidance. They've got a number of tools. Negative rates is not one of them. That's great for the banks. And that's also the reason banks have been trading down. People have been worried about that. They're not going to do it in the United States. So, and that was confirmed. Other data, leading index, we just covered. That was from negative 6.1 to positive 2.8 this week. The initial jobless claims, if you take a look here, were they missed expectations. They were supposed to be 1.3 million. They were 1.5, but they were still down from last week. And I think this is Heidi Chung from Yahoo puts this chart out every time there's a report. And as you see, this is continuing to slope down in the right direction. So it's flattening a little bit because you've had such an abrupt improvement. So this will be a little choppy now as we continue lower. So the trend is your friend, and that's going in the right direction. Same with continuous jobless claims. Missed expectations by a bit, but still improving month on month. Next, we had the oil. So Cushing was a big draw. We missed expectations. We were supposed to have a modest draw. We had a build of 1.2 million barrels. That's residual. However, we're down from a build of 5 million last week. So this is all trending in line with what we talked about in the recovery data, which is this is the inflection point in June where we move from May we had builds, and we're going to start to have consistent draws moving forward due to the cuts. And now they've got everyone on board with compliance. I think I saw a note 87% compliance after the last meeting. The Saudis basically laid down the law. They said, either you guys comply or we're out and we'll just bury you again. And they all said, okay, we'll comply. So, they'll have to keep scolding them like children, but they're going to comply. Otherwise, they're going to just blow themselves up. And so that's a good thing moving forward. Building permits, everyone was worried about this. It's up 20%. Okay, so it missed by a hair. It's up 20% sequentially. Housing starts missed by a hair. It's still up 5% sequentially. Mortgage applications are up every single week. This week it was up 8%. Next was business inventories beat. Capacity utilization was an improvement, but again missed by a hair. Retail sales was the big blowout number. Everyone couldn't believe. They were expecting plus 8%. It was almost plus 18, 17.7%, up from negative 14.7%. So that was the big tell because 70% of the economy is consumer. They were back in force, and they've got so much in savings, and their balance sheets were strong coming in. They've gotten even stronger. You let them out of the house now, they're going to spend, and things are going to rock. So that was the real highlight of the week. And the one that wasn't talked about was New York Empire State Manufacturing Index on Monday. This blew the doors off. It was negative 48 last month. It was expected to be negative 27 this month, and it came in at negative 20 basis points. So almost flat from negative 48% last month. This is beating expectations. The numbers are showing it. People want to get back to work. They want to make things happen. Okay, next we have the TSA numbers are up even a bit this week. So last week we had a high number of 544,000. Yesterday we hit 576,000. So this is moving in the right direction. Good news there. This is the one that I've voiced concern with over the last few weeks. I said on this podcast, VideoCast, my number one worry was every time things start humming, Powell has a tendency to take his foot off the gas. And this is the wrong time to do it. You don't do that until you're at mid to low single digit unemployment. You do not do it yet. And they did it this week. Okay, so hopefully this is just a blip and they get back on track here. But this is not the time to take your foot off the pedal. This is the time to speed up. When you have momentum, you press momentum. And then when you're so far ahead of the curve and, unemployment starts dropping by 300 basis points per report, then you can tighten it up quickly. But you don't want to kill all this effort by starting to pull back too soon. Huge mistake, and hopefully we'll see this turn up in coming weeks and keep the momentum while we've got it, and take this up a notch until those unemployment numbers really drop back to levels where everyone has jobs again, historic unemployment rates like we saw in January. Keep the pedal to the metal. Next is earnings. If anyone gets cut off in the last few minutes on the podcast, just go to hedgefundtips.com. You can watch the last few minutes on the VideoCast. You just fast forward the YouTube video to the end, and it's word for word exactly the same. Each week I do a couple sectors. This week I did the IBD Investors Business Daily Top 50 Growth Weighted Stocks. I did their 2020 and 2021 earnings estimates. What was really interesting was in the last 60 days, in spite of all that we've been through, these top 50 growth stocks have increased their 2020 estimates by over 5% in the past 60 days. Who would have thought, that in the midst of this chaos, that earnings would actually go up for some of these companies? But that's exactly what happened. And that also happened for the top 30 weights of the Russell 2000, the small cap stocks. Their 2020 earnings flatlined, so they were negative 1.09, but the 2021 actually rose by 1.66% in the last 60 days. So this is good stuff that we're seeing that no one's really paying a lot of attention to, but are critical for the underlying recovery. And then we want to take a quick look at S&P earnings. This is key. So the estimates stayed up here at 163.88 for 2021. In 2019, earnings came in at 163.02. We traded up to 3,400 peak with a higher discount rate, meaning rates were higher, so multiples should be lower. Now rates are lower, multiples can be higher, and that would imply that we've got some room to run. Certainly 3,400 could get into the cards as we move closer to these earnings numbers. And I think this will be one of those rare instances. Usually earnings get taken down as the months go on. I think in this case, we may see earnings get taken up with the amount of stimulus. I think people are underestimating the impact of that money starting to circulate as demand comes back and people get back into the economy, which we've covered in recent weeks. But earnings stayed up strong, so that's really good news. And finally, we're going to do the Ask Me Anything question for the week. And this one came in again from Ben. He said, "Hey, Tom, in Thursday's Hedge Fund Tips Sentiment article you wrote, it appears there may still be a bit of gas in the pain trade higher. Now that we got the shakeout last week, we'll take it day by day." He says, "The above isn't very optimistic in light of the AAII numbers in your article. Bullish percent at 24.37% and bearish at 47.78. And so hats off to Ben. He's been paying attention. Those are extreme indicators. And I agree with him. I may be being conservative, but that's just my nature. I like to underpromise and overdeliver. That's just always been a good way to win in life. So I would say, number one, you never want to rely on just one indicator. So there are, I look at a couple hundred, and you can see them, a good portion of them on the site under the indicator of the day. I have got about 100 videos up here. You can look at them. So I look at these every week, and there are a lot of them that are seriously overbought. Okay, but I'd say about 65% of the 100, 65% are seriously overbought and 35. So it's nice to see these sentiments so pessimistic, because it does mean you can push higher, and you're spot on, Ben, and you've been paying attention and you learn, and I agree with you. But I look at a mosaic of things, and, enough of them are near overbought that you don't want to be too aggressive, expecting too much. But I think the theme of your question is correct. I do think we can push higher, and it may exceed expectations in coming months for sure. We're using pullbacks as opportunities moving forward. So thank you for the Ask Me Anything question. If anyone else has one, just email me during the week, and we'll include a few on each weekly podcast VideoCast. And we're going to finish on time this week. So I'd like to thank everyone for tuning in. We're going to be back next week, same time, same place. And make it a great one. Bye-bye.